This post from the official US Treasury Department has over 10 million views. It's showing off that bond market returns have been substantially higher under Trump than under Biden. Most of the views come from people making fun of it. For example, Chris Hayes tweeted, "This chart is so funny, I thought it was a parody account." Or this guy, I believe he's an editor at The Economist, tweets that rising bond prices can imply lower future growth expectations. That's bad. Travis Akers puts it really simply. He says, the higher the bond return, the worse the economy is performing. But that doesn't seem right. The economy wasn't doing great in 2022, for example, when bond market returns were really negative, around minus 15%. So what's going on? To understand, we have to think about what we're plotting. This is total returns on 10-year Treasury notes. So let's think about a simplified example of a Treasury note. Our Treasury note has a face value of $100. That means at the end of the term, the Treasury is going to give me $100. We've got an expiration or a term 10 years from now. We're talking about the 10-year Treasury notes in this example. And finally, we have an interest rate. So the Treasury is going to set an interest rate that they're going to pay. 4% of the face value every year that you hold this Treasury note. So if I buy this Treasury note for $100, I'll get $4 a year for 10 years. Now, this Treasury note has a value. It has a value that I'm willing to pay for it when the Treasury sells it on the market, or a value that I would buy it for if someone else had this Treasury note and they were offering to sell it. So maybe I'd pay $95 for this Treasury note. I pay $95 now, I get $4 a year for 10 years, and then I'll get $100 back. So how could you lose money on this? Well, you don't have to hold the Treasury note all 10 years. Just like you could sell a share of stock anytime you wanted, you could sell your Treasury note anytime you wanted. You could sell it tomorrow. But the value of your Treasury note will fluctuate over time. Just because you were willing to pay $95 for it yesterday doesn't mean other buyers are still willing to pay $95 for it today. Just like you might buy a stock for a certain price and the value of that stock might go up or down. That's what we're seeing here. It's telling us that the total return, which is going to combine the interest rate being paid, our $4 a year, it's going to combine that with the value of our Treasury. It's saying the total return of Treasury bonds is going down in 22 or up in 25. Why? Well, the Treasury website lets you review Treasury notes that have been sold at auction. If you collect the Treasury notes and look at the interest rate, you can get this plot. I've shaded Trump's first term and second term in red. This line is showing us the interest rate on the 10-year Treasuries that the Treasury is selling. What you can see here is towards the end of Trump's first term, the interest rate is falling from over 3% to near zero. So what happens to the value of your Treasury note if the US Treasury Department starts selling other Treasury notes with a lower interest rate? Well, your Treasury note is relatively more valuable. So if the Treasury Department is selling Treasury notes with a 0.5% interest rate, and people want to buy Treasury notes, they would prefer to buy Treasury notes from me. I've got a Treasury note with a 4% interest rate. That's much better than what the Treasury is currently selling. So the value of my Treasury note would go up. And that's what you see in the plot. The total return is the value at the end of the year minus the value at the start of the year, divided by the value at the start of the year, and then you take into account the interest payments to get the total return. So interest rate declining, remember, the Treasuries that you currently hold becoming more valuable, that's what you see here. And then next on the plot, after 2020, interest rates go way up, over 4%. So what would happen to your Treasury note if the US Treasury Department were selling Treasury notes with a bigger interest rate, 6% instead of 4%? Well, the value of your note would go down. Why would people want to buy your Treasury note from you if the US Treasury Department was selling new Treasury notes with a higher interest rate? The value of your note would go down. You paid $95 for it, now it's worth less. It's worth 90, it's worth 89. I'm just making up numbers, but the point is the value would go down. So interest rates up, value down, way down, minus 15% in 2022. And then more recently, in Trump's first term, interest rates are coming back down. Oh, that's good. So you bought one of those Treasury notes with the high interest rate. Now the Treasury Department is selling notes with a smaller interest rate. You get the idea. Your Treasury note becomes more valuable. So I think a lot of people commenting and dunking on the Treasury Department are mixing up yield and total return. Yield on the Treasury notes, that probably is a negative economic indicator. It means that the federal government has to pay more in order to borrow money, and that's not good. But total return is a relative measure. It means that the Treasury bonds you bought last year become relatively more attractive. And so that's related to yield, but it's different. Finally, this is probably not related to Trump's actions or Biden's actions. The interest rates aren't literally set by the Federal Reserve, but the Federal Reserve basically, well, for this video, we'll pretend it is. The Federal Reserve is determining basically what the interest rates are. And the Federal Reserve is doing so in response to macroeconomic conditions around inflation and unemployment. So probably it's macroeconomic conditions driven by COVID that cause change in interest rates that drive these big total returns, or the big picture story in total returns. And finally, I think contrary to what the tweets dunking on this would have you believe, I think we should hope this trend continues. If interest rates remain high, that means a greater share of federal spending will go to pay the interest on the national debt. Our national debt is made up of Treasury notes. The interest that you get for holding a Treasury note, that's the money that the federal government spends on interest. So if interest rates are high, a greater share of federal spending is going to go to our national debt. So I think we should want interest rates to decline. And if interest rates decline, then we'll see probably a higher total return for, this is not financial advice. I'm working through this while I speak right now. We'll see a higher total return for holders of US Treasuries. That's just my speculation. Thanks for your time.